$200K in life insurance gains just became a $40K net payment. You think surrender means one tax hit. It's actually three, and the research shows most policy owners have no idea until they file. You own a permanent life insurance policy, maybe whole life, universal life, or variable universal life. You've been paying premiums for 10, 15, maybe 20 years. You've built $200K in cash value, with $80K sitting in gains above what you've contributed. Now, before retirement, you need that money, so you call your agent and say, I want to surrender the policy. Your agent says, you'll pay a surrender charge and ordinary income tax on the gains. You do the math, 15% surrender charge on $200K is $30K, plus maybe 25% ordinary income tax on $80K in gains, another $20K. Total, $50K out, net $150K back. You're okay with that, but that's not what happens. Research shows the actual bill is $60K, $100K. Here's why. Rehook 1, the math doesn't add up. Layer 1, the surrender charge. That's real, 15-25% of your cash value, depending on how long you've held the policy. Per NAIC disclosure standards, that's your first penalty. On a $200K policy, you're looking at $30K, $50K gone immediately. This isn't income tax. It's a contractual penalty for early exit written into your policy contract on page 47, the part most people never read. Layer 2, MEC status. Here's where most people get blindsided and where the tax bill explodes. If your policy was funded heavily in the early years, you maxed out contributions to build cash value fast, or if you took loans against it. The IRS may have reclassified it as a modified endowment contract under IRC section 7702. That's the Internal Revenue Code section that's cost policyholders over $2 billion in surprise taxes since 2015. Once your MEC status, early withdrawals don't get favorable tax treatment. Instead of last in first out ordering, you hit ordinary income tax on gains first, plus a 10% penalty if you're under 59.5. On $80K in gains, that's $8,000 in IRS penalty alone, per IRS publication 590B. And here's the thing, you might already be in MEC status and not know it. Your agent never had to disclose it unless you specifically asked. Layer 3, ordinary income tax on the full gain amount at your marginal rate, not the standard 15% capital gains rate. If you're 55-65 with $300K household income, you're likely in the 24-32% federal tax bracket. Some earn enough to hit 37%. On $80K in gains, at 32%, that's $25,600 in federal tax alone. Add state tax, California, New York, Massachusetts residents are looking at another 3%, and you're paying $29K, $35K in combined federal and state on the gains alone. Rehook 2, the total damage, add them up. $30K surrender charge plus $8,000 MEC penalty plus $25,600 federal tax plus $5,600 state tax equals $69,200 in total outflow. Your net from that $200K policy, $130,800. You lost $69,200, 35% of your cash value, not the $50K you calculated. That's $19,200 more in taxes than you expected. But it gets worse depending on your filing status and income situation. Single filers in the $200K, $250K income range face a 24% federal bracket, but hit the 32% bracket on the gains themselves, which means the marginal rate on the surrender is 32%, not 24%. Married filers filing separately face penalty phase-outs on retirement benefits if you're near the Social Security threshold. A widow or widower in the year of filing status change could see an extra $15K, $20K hit due to tax bracket stacking. Here's the critical part. If you're in the 37% bracket, $578, $750 plus household income, that $80K in gains cost you $29,600 in federal tax alone. Add a 13% state tax rate, and you're paying $39,040 in combined taxes on that gain. Suddenly, that $200K policy nets you $91,760. You've lost $108,240. Rehook 3, the solution you weren't told about, but here's the opening loop I promised. There is one way to defer this entirely. If you structure the surrender as a tax-free exchange into an annuity, a 1035 exchange, per IRC section 1035, you avoid the immediate gain recognition. That defers the tax to when you start taking distributions from the annuity, potentially shifting the entire tax hit into lower-income retirement years when your marginal rate drops from 32% to 22%. On that $80K in gains, dropping from 32% to 22% saves you $8,000 right there. Plus you eliminate the $8,000 MEC penalty and defer the surrender charge through structured annuity withdrawal. But that only works if you don't surrender. You exchange, and most agents don't mention it because they don't service annuities or because the policy is already non-qualified for exchange due to previous withdrawals. The research is clear. Surrender a $200K policy with $80K in gains during your peak earning years, and you're paying 3 separate penalties totaling $60K, $100K. Do it after you retire, and your income drops to $80K, and that same surrender costs $15K, $25K less because your marginal rate fell from 32% to 22%. If you have a permanent life insurance policy and you're thinking about surrender before retirement, consult a tax professional before you call your agent. 1 hour with a CPA who understands IRC Section 72E, Section 7702, and Section 1035 exchanges could save you $40K, $60K. That's not just smart money. That's the difference between retiring on schedule and working 3 more years. The tax code rewards those who study it.